Welcome back to FinScribble. Today, we are diving into a frustrating financial mystery affecting thousands of smart, responsible borrowers across the country. Meet Maya. Maya has worked hard for many years to build a pristine 750 credit score. She sits down at her laptop to apply for a standard personal loan, assuming her stellar rating will unlock a low single-digit interest rate, like 4 or 5%. But when the loan approval screen flashes, her jaw drops. Her offered rate is 12.4%. Maya immediately double-checks her credit report, wondering if there's an error or a hidden fraud mark ruining her record. But there isn't. Her credit profile is completely spotless. So why is a borrower with great financial habits being quoted an interest rate that feels like a heavy penalty? It turns out the financial rules of personal lending have shifted dramatically right under our feet.
To understand what happened to Maya, we have to look at the broad national data. According to recent financial benchmark studies from Bankrate, the national average interest rate across all personal loans sits right at 12.41%. That is not the average rate for high-risk borrowers or debt rebuilders. That is the baseline average across all major lenders for everyday consumers with solid credit scores. When central banks raised interest rates to combat high inflation over the past few years, the baseline cost of capital for lending institutions skyrocketed. Lenders must pay far more money just to secure funding themselves, so they pass those elevated expenses directly down to consumer loans. Even if you have never missed a single payment in your entire adult life, your interest rate floor has fundamentally reset. The cheap money era is officially over, and 12% is now the standard starting line. To visualize why this feels so jarring, picture Maya holding a gleaming golden shield. On the front of this shield, in big, bold numbers, reads 750. For decades, classic financial advice taught us that this shield was impenetrable. If you maintained great credit, the shield protected you from high interest rates, predatory fees, and strict lender terms. But today, that golden credit shield has hidden holes poked right through it. Market-wide interest rate spikes bypass your credit score completely. Lenders are also adding heavy risk adjustments because economic uncertainty makes even good borrowers statistically riskier to fund. Maya stands behind her shield, expecting full protection, but high loan offers slip right through those wide gaps. Your credit score still matters for basic approval, but it no longer acts as an ironclad fortress that guarantees cheap borrowing costs. The traditional safety net now has gaping holes all over it. Where you decide to shop for a personal loan makes a massive financial difference in today's market. Federal credit unions operate under strict federal regulations that cap their personal loan interest rates at 18% maximum. That legal ceiling provides a real safety barrier when overall market interest rates climb. On the flip side, fast online Fintech lenders operate under entirely different state-level lending rules. Many popular online platforms can legally charge interest rates as high as 36%. They trade speed and instant automated approval for astronomically higher borrowing costs. If Maya simply clicks the top sponsored link on a search engine without comparison shopping, she could easily end up paying triple the interest rate she would at a local credit union. Convenience has become the most expensive feature in modern consumer finance, so knowing where legal rate caps exist is vital for every borrower. There is another hidden reason lenders are raising rates across the board: invisible phantom debt. Meet Jordan. Jordan has a great credit score, just like Maya, but Jordan frequently uses buy now, pay later services to split up everyday purchases. Jordan buys designer shoes, electronics, and even grocery orders across 4 or 5 different payment split apps. Here is the catch. Most buy now, pay later debts do not report monthly installment balances to traditional credit bureaus like Experian or Equifax. To an underwriter, Jordan's credit report looks pristine and unburdened. But in reality, Jordan is quietly carrying thousands of dollars in hidden short-term installment debt. Because traditional lenders cannot see this full financial picture, they know debt stacking is spreading rapidly across the economy. To protect themselves from these invisible default risks, lenders raise baseline interest rates for everyone, meaning responsible borrowers end up subsidizing the hidden consumer risks of unrecorded microdebts.
So, how can you navigate this tricky new lending environment without getting burned? First, always understand that your credit score is still your entry ticket, but you must shop strategically. Always check local or federal credit unions before considering high-speed fintech platforms so you lock in regulated rate ceilings under 18%. Second, clear out any small buy now, pay later balances before applying for a major loan, as lenders are increasingly scanning bank transactions directly. Finally, calculate the total overall dollar cost of interest over the entire life of the loan, rather than focusing solely on lower monthly payments. Maya adjusted her strategy, joined a nonprofit credit union, and secured a far more manageable rate. Having good credit might not be a magical bullet anymore, but armed with the right knowledge, you can still outsmart high interest rates and take total, confident control of your personal financial future.
As always, appreciate you hanging out today. See you in the next one.